I'm sure you have come across many stock prices many times in your life. But have you ever thought of a stock price as a public good? Something like clean air that everyone can enjoy without directly paying for it. In the ideal world, the price of a stock would exactly reflect the true value of the stock at all times. Also, in the ideal world, the stock market would be a level playing field, and no participant would have an unfair advantage over others. Unfortunately, we do not live in the ideal world. This is why, to maintain market integrity, securities regulators like SEBI throughout the world banned two practices in stock markets: insider trading and market manipulation. In this video, I will talk about both of these practices in detail. Let us begin with insider trading. Consider the example of a merger and acquisition or an M&A transaction. An M&A involves one company buying another company. The buying company usually buys at a price that is higher than the current stock price. This is why in most cases, when the market gets to know about an M&A, the price of the company being bought increases. This is a very well-known phenomena in the finance world. A lot of people work on any given M&A deal. These include employees of the buying company, employees of the company being bought, investment bankers, lawyers, and various other contractors. All of these people know about the company being bought, and some of them also know when the deal will be announced to the market. These people are known as insiders. Let's say an insider knows that an M&A will be announced to the market on 15th October. They can buy the shares in the company being acquired for, let's say, 200 rupees on 10th October. If the price goes up to 300 rupees on 15th October because of the M&A announcement, they will make a 50% profit in just 5 days. Essentially, they have made a very high profit by using a piece of information that only they knew, but nobody else in the market knew. This practice is known as insider trading. Insider trading can occur before any important announcement like an M&A announcement that insiders know about before it happens, and because of which there is a large increase in the stock price. Now you might ask, why is insider trading illegal? To understand this, consider another example. Let's say you own a car. The car has a hidden defect that cannot be detected easily in a test drive or even after driving the car consistently for a few months. However, the defect is important and it lowers the performance of the car considerably. You know this, and you know that telling this information to a prospective buyer would almost certainly cause them to back out of the deal. Let's say you sell the car without disclosing this information, and the buyer comes back to you after a few months once they discover the issue, demanding their money back. From an ethical standpoint, one could argue that you have in fact cheated the buyer. You have not disclosed important information about the product that you knew, and that could have led the buyer to change their mind had they known it before the deal. You had an information advantage over the buyer, and you unfairly used this advantage to get the deal done. A similar argument can be made about insider trading. Insiders have a natural information advantage over others because of their occupation. If they are allowed to use their advantage for their own profit, they would effectively be cheating the market. To make the stock market a level playing field, SEBI does not just ban insider trading, but they also try to catch cases of insider trading and make sure that the culprits are punished. They also implement very strict rules that prohibit sharing insider information with friends and family. However, insiders are also clever. To hide from SEBI, instead of trading the stock in which they are an insider and which SEBI is very closely watching, they trade other instruments like options or funds like exchange traded funds or ETFs, or even stocks of rival or peer firms. The prices of all of these instruments typically move because of announcements like the M&A announcement that the insiders already know about. Although trading these other instruments reduces their profits, but it can help them hide better from SEBI. Sometimes insider trading is like a cat and mouse game between SEBI and the insiders. Now let's move on to market manipulation. If insider trading is like cheating someone by using information you have unfairly, market manipulation is, at times, directly stealing money from others. The simplest form of manipulation to understand is pump and dump manipulation. In a pump and dump scheme, the manipulator first buys some shares in a company. Let's say that the manipulator has bought one share at a price of rupees 100. Then the manipulator spreads some fake good news about the company. For example, the manipulator might say that the company has discovered the cure for cancer. Some people believe this news and buy the company's stock thinking that the price is going to go up because of this cancer cure discovery. Their buying activity pushes the price of the stock up to, let's say, 500 rupees. Once the price has increased, the manipulator sells their shares at a profit. If the manipulator sells at a price of 500 rupees, they have made a 400 rupee profit because they bought the share at only 100 rupees. Mostly, the manipulator is selling their shares to people they have managed to fool into believing the fake news and buying the stock. The phase in which the price goes up is known as the pump phase. Once the market learns that the news is fake, the stock price crashes and returns back to the initial 100 rupee price that existed before the fake news was released by the manipulator. The second phase in which the price goes down is known as the dump phase, and that's why this whole exercise is known as pump and dump. Investors who bought the stock in between 100 and 500 will make a loss because they've actually bought a 100 rupee stock at a higher price. Essentially, what has happened is that 400 rupees has gone from the pockets of these innocent investors who fell for the fake news into the pocket of the manipulator. This is why I said before that market manipulation is like stealing. Other than stealing, market manipulation presents one more problem. I said at the beginning of the video that the price of the stock should accurately reflect its true value. By spreading fake news, manipulators are artificially pushing the stock's price away from its true value for their own benefit. This means that any investor using the stock price to learn the stock's true value will actually get an inaccurate picture of the reality because of the manipulator's actions. Like insider trading, SEBI also tries their best to detect and punish market manipulation. However, manipulation still exists and manipulators can't prosper until they are caught by SEBI. In fact, in my research, we have found that pump and dump manipulation occasionally occurs on messaging platforms like Telegram and Discord. This Telegram manipulation is popular in cryptocurrency markets especially, but has now found its way into many stock markets throughout the globe, including the Indian market. This type of manipulation is carried out openly, and anyone, even you or I, can become victims of this manipulation if we are not careful. So I hope this video has helped you learn a bit more about practices such as insider trading and market manipulation and why they are illegal. I wish you all the best in your investing journey.